Cloud here. Well, hello, everybody. This is rickbanez with Fred REIA, and I am joined here by Paul Moore. Paul is going to talk to us today about commercial real estate investing. And a lot of our members in Fredericksburg have dabbled and continue to invest in real estate through regular home ownership and renting it out through property management and things like that. But I think Paul is going to have some interesting twists that are going to open our eyes to different ways to think about real estate investing. And I'd like to welcome Paul Moore.
All right, great to be here. Thanks, everybody. Hope as nice a day as where you are as where Rick and I are in Virginia. So, hey, a few disclaimers here. Basically, this is not a pitch. We're not trying to sell securities. If you did want to buy, if you did want to invest, you'd have to be accredited. These are our opinions. And a lot of these IRRs and returns we're showing on here are gross property level, which means investors didn't necessarily make this much. So again, I'm Paul Moore. I had an engineering degree and an MBA, worked at Ford Motor Company in Detroit for almost 5 years. And then I started a company with a friend that caught Wall Street's eye, and we sold that company in just 5 years to a small publicly traded firm. And so I started investing in real estate after that. I've written 3 books on real estate. I'll cover a couple of those tonight. I blog on Bigger Pockets and then the new platform called Passive Pockets that's rolling out this next month. I'm co-founder of Wellings Capital. Most importantly, I've been married 37 years, and we've got 4 adult children, 3 of whom still talk to us. No, I'm just kidding. All 4 of them still talk to us, and it's great. But it sounds great, like, oh, he's a serial entrepreneur. Well, I thought about putting that on my business card, Rick, once, and that was such a mistake to think that way. Because being a serial entrepreneur means I was a shiny object chaser. And I thought I was a full-time investor, but I wasn't really. I was a speculator, and I lost a lot of the money I made doing that. Now, I made money too, but as I got older, lo and behold, I got sick of the roller coaster of ups and downs and starting new companies and shutting them down. And I can't even remember them all now. And so I started a podcast in 2016 called How to Lose Money. And Josh and I interviewed 238 speculators, investors, entrepreneurs, real estate owners. And it could be really depressing to talk about the penny stocks that I bought and were later not worth a penny. And the Charlotte entrepreneur I invested with in 1999, who offered 35% annual profits. He's now on year 24, I think, of his 153-year prison sentence. 2,000 investors never got our money back. The waterfront home I built that I should have made an $80,000 profit on, and I lost $40,000. And I bought the guy a bulldozer. I don't know how that happened. Anyway, but great news for my family and for you listeners. I actually made more money than I lost. And I'm here tonight hoping that you will stand on my shoulders and let my ceiling be your floor. I invested in about almost 100 residential real estate deals, about 60 flip houses, and probably 30 to 40 waterfront lots at Smith Mountain Lake in Virginia.
Oh, very familiar.
Not Lake Anna, sorry.
No, it's
But
okay.
Smith Mountain Lake.
The real lake.
I'm going to be at Lake Anna in 3 weeks, though. I love Lake Anna too. But in 2011, my partner and I progressively built a quasi multifamily property. And I went on to write a book that was humbly entitled The Perfect Investment, about multifamily investing. And I really, really loved multifamily syndication and investing until I didn't. And then I started going on Bigger Pockets for years, writing that it's about to blow up, it's overheated, it's a bubble. And that's exactly what happened. I didn't know how it would fall apart, but it did. So before I go on, I want to briefly talk about why I like investing in commercial real estate. There's many reasons over residential. I try to make this house on the left look like it was remodeled into the house on the right, but nobody's believed it so far. The trees just gave it away. But seriously, I learned a lot about commercial real estate. What I learned was that commercial real estate, you can a lot of people who make a lot of money in single family or residential, they love it and they do well with it. But I didn't even know how to tighten my own doorknob, Rick. So I had to get contractors to do all the work. They ripped me off. Like I said, one stole my bulldozer. It was terrible. But I found that investing in commercial real estate, especially investing passively, can provide a whole lot of us with options that we wouldn't otherwise have. Um, Buffett said, if you don't find a way to make money while you sleep, you'll have to work until you die.
Oh,
And
yeah.
for me, now just for me, not necessarily for all you listeners, I wasn't making money while I slept. I was flipping single family homes and I'd make money when I flipped them, but then I wouldn't be making money other times. And when I tried to get some single family rentals, don't do mobile homes, I actually found that I was dealing with toilets, tenants, and trash. And I definitely was not getting much sleep with that. But what I love about commercial passive real estate investing is John D. Rockefeller, and the wording is funny here, but he said, I'd rather earn 1% from 100 people than 100% of my own efforts. And I love that quote because that's kind of the philosophy we've adopted. One of our investors had a kind of a cool quote as well. They said, why should I work harder than I need to make less than I could? I think they were trying to buy real estate on the side when they had another gig, and they're like, they're like, wait a minute, why shouldn't I just invest this passively? And again, there's no silver bullet. There's no guarantee it'll work to invest passively, but I think I can make a case tonight for why some people should consider it. And I'm going to start my case by relying on a non real estate investor, another one. Buffett was one. Another is Jeff Bezos.
Hmm.
Now, he taught me a lot about math because Jeff Bezos, Amazon, last I checked, has about a 51 price to earnings ratio. I don't know what it is today, it's different every day. But that means that if he can save a dollar, and he's famous for saving money, for cutting corners, he actually took the light bulbs out of all the vending machines in all the facilities, Amazon facilities around America, probably around the world, because he said, why should I burn that extra electricity just to advertise Lance snacks? Why should I have a maintenance person have to go in and pull that cover off and put in another light bulb? He knows that saving a dollar a month is, this is really deep math here, guys, $12 a year. $12 a year with the price to earnings ratio added to your bottom line turns out to $612 in value. So a dollar saved, $612 in Jeff's pocket. That's pretty cool.
Heads up.
So that's a pretty good ratio, isn't it, Rick?
Hmm.
So, well, good news. Commercial real estate works somewhat similar. It's based on math. Now, the value of commercial real estate equals the net operating income divided by the capitalization rate or the cap rate. Now, the cap rate is sort of like comps in residential real estate, but it's not based on the comps of the neighborhood. It's based on comps of the income. And what I mean is people who buy commercial real estate, they basically say, hey, we'll sell this for a certain amount of money per dollar of net operating income. So keep this formula in mind because it's going to become really powerful here in a minute. The value is the net operating income, which you can totally change for the good or the worse, divided by the rate of return or the cap rate. We'll call it a rate of return, call it 6% just for the moment. So
Okay.
why does the Forbes 400 really invest in commercial real estate? Because a dollar added to the bottom line is $12 annually. That's that deep math, divided by a 6% cap rate. And that creates $200 in added value at the asset level. But it could be better than that because if you use safe debt, you might impact like 60% loan to value debt. You can actually, that $200 might have a $500 impact on your equity. That's kind of not the right
Oh,
way of saying it, but hopefully you know what I mean. It leverages. We can all use leverage, and of course, house flippers and all kinds of people use it, but I'm just trying to give you an example of how it works in commercial real estate. Now, let's look at some examples, and we're going to have to move quickly through these. So, if you fill 15 vacant apartments at $1,200 a unit, now here's the math. 1,200 times 15 is 18,000 added to your bottom line every month. Assuming that doesn't cost you anymore, that 18,000 a month is 216,000 added to your net operating income. Well, that's really good, but divide that by 6%. Remember our formula, divide it by 6%, and you're actually creating an income, of 3.6 million, not income and value, excuse me. So you just went up 3.6 million in value by, let's say it's a 100-unit apartment building with 20 vacancies. If you fill 15 of them, you might be able to increase the value of that property by 3.6 million. That's very powerful.
wow.
Um, or if you save $25 a month on water bills times 125 units, well, okay, well, that doesn't sound like much. Well, that $25 a month divided by 6% on an annual basis, of course, creates 625,000 in additional value. Or if you raise the lot rent at a mobile home park by just 5%, let's say that's $15 a month on a $300 lot rent, multiply that by 300 spaces, that creates, get this, that creates 54,000 a month, a year in income divided by 6%. That's 900,000 increased value just by
Wow.
raising the lot rent by 5%, Rick.
And
You could
these are
get
the
the,
things you can't do in residential real estate. I mean,
exactly.
you've got one lever to pull, which is your rent.
Right. That's right. Let's say you negotiate a cable or internet deal at $25 a month times 500 units. You just created 2.5 million in wealth for you and your investors. You can spend $100,000 to add paid outdoor storage. I know a guy who did this. He had an acre out front of his mobile home park. He put a paved, fenced area, and he rented that storage out so people could take their second or third car or fourth car or fifth car up on blocks and their RV and their boat.
RV,
And
right?
yeah, and they could put that in and cleaned up the mobile home park, but he also created um, $9,000 a month in income. Okay, $9,000 a month in income divided by 6%. If I did the math right in my head, that creates 1.8 million in additional value. He only spent 100,000 to create the lever, as you called it, Rick, to be worth 1.8 million.
Mm,
Very, very powerful. Adding
huge.
U-Haul. You can make $3,000 a month adding U-Haul at a self-storage facility. That's worth $600,000. You can add point of sale items for just 1,000 a month and create 200,000 in value. You can add insurance and late fees at a self-storage facility at $5 a month. Just 500 times 800 units creates, 800,000 in value. So the power is in the intrinsic value. Rick called it a lever, and that's right. I call it intrinsic value. Now, intrinsic value, Buffett said, when you can see something that has a price here, but intrinsic value, potential value of here, well,
Mm-hmm.
that's when he really wants to buy those stocks. Michelangelo, the greatest sculptor, most famous sculptor, at least of all time, he said, the sculpture is already complete in my mind. It's just I have to chisel away all the superfluous material to get there. And so, Michelangelo could take this $200 block of, what is that? Marble,
Marble, yeah,
and he could create a $1 million sculpture. Not that that's Michelangelo, but that's
right.
the point.
That's
And
the idea.
Buffett's actual quote is, price is what you pay, value is what you get. So you've heard of value add investing. Tonight, we're going to talk about something similar. I call it intrinsic value extraction. And it's just a fancy way of saying value add investing. But I thought it would impress you guys since I already told you that I lost a lot of money and I don't want you to tune out only 16 minutes in. So, intrinsic value extraction is spotting discrepancies between the extrinsic value and the intrinsic value, and then correcting those discrepancies by doing smart things, then raising the net operating income and therefore the asset value, and then extracting that value through higher cash flow and or refinancing and or selling. And so that is the formula. And so the question is, how can you get in? Because there's really big barriers to entry, and it's really hard to get on ramps. And there are companies out there, they're called syndicators or funds, and you probably knew that, that can actually understand intrinsic value, can actually beat the market and create on ramps for investors to invest passively. Does that make sense?
Mm-hmm. Now, is that where this is, I mean, your opportunity that you're looking for with your company, that's what you're doing. You're looking for these intrinsic value extraction points, correct? So the
Absolutely. Yeah.
weaker ones, the ones that are not doing all that they can. Maybe they're mom and pops. Maybe they've been in the business
Yeah.
for 20 years and they've checked out or something like that.
Yep.
So
That's
that's
right.
that's what you focus in on.
Yeah, absolutely. And so our company, and again, this is not a pitch for our company, but our company is looking to to go up the Pareto curve. Now, Pareto principle, you might remember, I can't remember his first name, but Pareto in the 1800s did some math and he realized he developed this skew curve. The skew curve says that 80% of the people, let's say it differently, 20% of the people in your church will do 80% of the work. 20% of the people in your company will produce 80% of the outcome. 20% of the criminals will create 80% of the crime, and so forth. And so we are looking for operators, and we recommend that you, as a passive investor, look for operators who are in this top 20%. Now, here's why. Because if you get an average deal, let's say you're the 50th percentile, you get an average deal in an average market on an average year, and you'll get average profits, which are right here. The problem is the problem and the opportunity, I guess. The last decade, I'd say from 2010 to 2022, so that 12-year period, the rising tide lifted all boats.
Oh, it did.
And an average deal, Rick, was incredible right here, okay? Because the rising tide lifted that average deal way up here, okay? The problem is Buffett said someday the tide's going to go out and then we'll see who's skinny dipping. And that's exactly what happened. And that's why I pulled out of multifamily investing after writing a book humbly titled The Perfect Investment and decided to go elsewhere. And we can maybe get into that later. But the point is, we're looking, and you should look for operators who are way up here, because let's say you're here at the 80% mark. Well, look, that result here is much better than the result at the 50th percentile. But if you can get in the top 20% of the top 20%, because the 80-20 rule is fractal, then you're in the top 4%. Your outcome could be up here. And
Mm.
the point of that is you want to be safely above that tide. And the analogy's starting to break down now. Don't worry about the tide. But anyway, you want to be safe when that tide goes out. And that's the first priority is, of course, Buffett said, don't lose money. That's our top priority. And that should be probably every investor's top priority. So what do passive investors need? Number one, they need deep focus. They need to get in this top 20% or top 4%, which is where I want to be. They want operators that have very deep focus, who are, they're not really diversified. They're not a new startup. They're not some new fresh idea. They need deep due diligence. They need to do due diligence. The investors do, but so do the operators need to do great due diligence. They need diversification. Wait a minute, I just said deep focus. That's not diversification. Well, the investor themselves needs broad diversification. So we like to diversify across different asset classes, operators, geographies, and strategies. And we even like to diversify in the capital stack, and I'll tell you about that later. But you also need access, and I've mentioned this twice. There are a lot of dark forces out there. I'm not trying to create a conspiracy theory, but there are a lot of people out there who would probably love to keep all the commercial real estate deals to themselves. Well, thankfully, the Jobs Act of 2013 and the syndication laws allow all of us, especially accredited investors, to get in on these deals. So, um, that's, honestly, I couldn't have done this talk 20 years ago because so many people couldn't have gotten in or wouldn't have known how to get in. But with syndication rules being relaxed, a lot of us can get in. That also means a lot of us can make massive mistakes. And that's why I'm doing this talk this evening,
Mm.
because I don't want you to be in that, bottom 20% for sure. And hopefully you'll be in the top 20. This is what we did last year. We looked at 515 operators and deals at my company. We're not an operator. We're just looking for deals to put in our fund. And of the 515 we looked at, Rick, we only invested in 4 that we didn't know, plus 7 we already knew and reinvested in. So that was 11 total.
Mm.
So that was basically 2% of what we looked at. And it's really hard for me because, I mean, I like doing deals, but our specialty at Wellings Capital is saying no. And it's it's hard to say no, especially when somebody has a great product, great project, great team, but we have to say no a lot.
Again, it's because of the um, not that you're looking for a home run, or are you? And is it because you're just trying to avoid that tide going out and being caught with your.
Yes. Yeah, we're not trying to hit home runs. We would rather hit singles and doubles with the chance that we'd hit an occasional triple or home run. But we're swinging for singles,
Gotcha.
basically. And
Okay.
that means our income, we probably won't double people's money in 3 to 4 years. But at the same time, there's a better chance, especially because of diversification, that we won't lose money. There's no guarantee we could lose anybody's money for sure, but the diversification helps. And so we're diversified across self-storage, mobile home parks, manufactured housing communities, RV parks, light industrial, debt, multifamily, open air shopping centers, and we even have a portfolio of single family rentals, taking up about
Interesting.
10% of our assets. Yeah. So,
Are any of these, based on, coming out of COVID, now we're into a new chapter of post-COVID. Do you see any of these numbers either shrinking or expanding? I mean, is your crystal
yeah,
ball open to
yeah,
maybe getting out of certain areas or at least reducing your footprint?
absolutely. So, self storage, I wrote a book on self storage, Bigger Pockets published it. And self-storage was the darling of all commercial real estate darlings coming out in the middle of COVID and at the end of COVID and coming out of COVID, but it's really not anymore. So we're actually putting more into mobile home parks now than we are self-storage. And we're actually going to talk later about why we're going more 39%. What are you doing, Paul? Multifamily. Because we see a unique opportunity there right now that we had never seen until the last few years.
Hmm,
So we'll get into that. The
interesting.
reason I brought up self-storage, the self-storage book, is I'm going to be using self-storage in a lot of my examples here. So as I know a little more about that, this is an example. You mentioned earlier, are these like just mom and pop opportunities that somebody's run into the ground or just maybe took their hands off their eyes off the ball, their hands off the wheel? Yes, here's an example. So this is in a suburb of Las Vegas. It was built in 1982 and owned by the same owner for 40 years. 40 years of handwritten records, 40 years of no online marketing and technology, 40 years of the seller collecting the rent, the owner collecting the rent in person, and even renting units to homeless tenants, which is against the law, and to family and friends for free. She was only charging $60 a month for a 10 by 10 unit, but the going rate in her area was 148. Well, that means we can raise the rent from 60 to around 148 after cleaning up the facility And remember our formula. If we double the income, and we more than doubled income, by the way, it's going to double, all things being equal, it's going to double the value of the
Value.
property. And
Hmm.
so if this property, and I literally can't remember what it was purchased for, but let's say it was 3 million. The appraised value of this now, you would think would be over 6 million. And I think that that's pretty likely the case. Though appraised value doesn't mean it'll sell for that. It might sell for much more or much less. You know how it goes. But um, that's an example. Now I'm going to go over some other value add examples, but I'm going to call them for fun intrinsic value extractions. So this one is in Grand Junction, Colorado. This was a neurotic seller. Um, it was acquired for 4.3 million. Exactly half of that was equity, half was debt. There were 650 units plus 114 RV spaces, 295,000 in income. Look at that, 80% in delinquency, Rick.
Oh, geez.
You think their eye was off the ball? Yeah. Um, it just happened to be a lady. I said her, and I feel bad because most of these are guys, but these last two happen to be ladies. She had a lot of issues. I'll leave it at that. And anyway, she would call the owner of my operating partner as early as 5 a.m. to tell her 2 hours of fears she had about selling to him. And he patiently walked through it with her. There was no broker involved. Took 6 months to turn this around and look at the results. It went from 300,000 or so in income to 450, and that's a 2.3 million increase in value. Remember, there was only 2.15 million in equity. So in theory, the equity owners sort of doubled their position. I keep saying in theory because, until it's sold, there's no guarantee that'll happen. But that's a pretty cool
That is
um,
80%
opportunity there.
delinquent.
I know that doesn't mean that means they were at least a month late. They weren't necessarily not paying. But yeah, so we're projecting a 47% gross IRR on this and a 4.2 multiple on equity. Um, and I would say that, it's pretty likely that something like that will happen. I'm being very careful because my compliance people don't like it when I make big promises and
Mm.
sweeping things. Oh, there it is. That doesn't look like much, and it's actually not. And that's the point. The point is, it wasn't that hard to make a lot of money on this pretty boring looking facility in Grand Junction, Colorado. There's another picture of it there. Again, kind of boring, but that's good. I like boring. The older I get, the boringer I want to be. Trust me. Anyway, so intrinsic value extraction number two. This was my business partner flew down to see this. This is in Bayville, Texas, and it was 606 units. You'd think in a town of 12,000 that might not work. They were asking 5 million through a residential agent for this. He bought it for the right price, which is 2.4 million. This was very unfortunate. There were 5 feuding siblings,
Oh,
and they had inherited it. And he bought it off market, paid cash for it. There was 91% occupancy, but there were 60 units delinquent. No web marketing again, high expenses, rents way below market. Got 320 move-ins and 2 rate increases approved, and U-Haul added, other income streams added, sort of the levers we were talking about earlier.
hmm.
They maintained their occupancy. The delinquent tenants stuff was auctioned off. 4 months later, they got an appraisal for 4.6.
Oh
Remember,
my
they only paid
gosh.
2.4.
Almost double. That's amazing.
Yeah. And now here's a point. They put new debt on it at that time of $2 million, Rick. Now, $2 million on 2.4 million would have been 83% loan to value, and that would have been a bad deal. That would have been risky. But now this 2 million in debt was only 43% of the new value of 4.6.
Mm.
And now they only have $400,000 left in the deal. They were projecting, well, an 84% IRR, eight times return on equity for the remaining equity for a 4-year hold. They actually end up selling it a year later for 4.6 million, that same appraised value.
Hmm.
And so it went really well. There it is. That's in Beeville, Texas. There's another view of it. And again, it's kind of boring. It's only 4 pieces of sheet metal, a floor and a door, and some rivets. And I'm not saying it's easy to manage. It's easy to manage poorly, and it's harder to manage well, but you won't have to manage it at all if you send a check to Security Mini Storage LLC and then just invest with them. That opportunity's, it's obviously too late since they've sold it, but you get the point.
Are you bringing in your own people when you're turning around a business like this, or
Absolutely not. No, we look for people who would never need our people.
okay?
Yeah. So we are looking for operators that are so good they don't need our help. And that means we can focus on just due diligence, finding the right deals, finding the right operators, monitoring them to make sure they're doing a good job, and then raising money, of course, from accredited investors who give
Got
us
it.
the money to do the work. So, given the fact that we're over halfway through, but I'm not halfway through the slides, I'm going to go a little faster. So, why do we love self storage? Well, it's a large and fragmented industry. It's historically been recession resistant. The main reason it's having trouble right now is, and you probably know this if you look around, Fredericksburg, if you look around I-95, you'll probably see that it's been overbuilt.
So many. Yes.
So many. So we love investing in places like Beeville, Texas, Ishpeming, Michigan, Lynchburg, Virginia, little towns that don't have huge, booming national brands coming in next door that can
Mm,
afford to lose money for a while.
makes
So
sense.
we like the business plan of acquiring from a mom and pop seller, fixing it up, grouping them together, and then selling to a national brand.
Mm,
And that's worked pretty good. Like this shows that the GDP, as it's gone up and down in red, the green line historically, self-storage has done really well. In fact, it did much, much better after this chart was over, but it's taken, like I said, it's what goes up must come down at some point. Why manufactured housing? Mobile home parks. It's the only asset class we know, Rick, that has increasing demand and decreasing supply every year. There really is an affordable home crisis, a housing crisis. And the truth is, while 10,000 people turn 65 today, 6 in 10 of those 6,000 of the 10,000 don't have $10,000 cash in their bank.
mm,
And it's pretty tragic and it's pretty shocking, but a lot of them do have home equity and they can sell that house, trade that home equity in to buy a mobile home for cash and put it on a lot and rent that lot for a fraction of what it would cost to have their mortgage or a fraction of what it would cost to live in an apartment with 4 walls and no backyard and all that. And so the current administration is mandating improving access to manufactured housing. This is a mobile home park we invested in Gillette, Wyoming. Um, I think a lot of the reason people haven't done well with mobile homes over the years is they had a stigma. The place I grew up on the
mm.
left there. No, I'm just kidding. But they have a stigma that it's like the one on the left, when reality it could be like the one on the right, and it could be somewhere in between. And we like it when it's kind of run down a little bit better maybe than the one on the left, but we can improve the park and make it look at least a little bit more like the one on the right. That's our goal. And the crazy thing about mobile home parks, Rick, is look at this. There's supply of all these sectors: apartment, industrial, malls, office, even office, strip centers, storage. But look at manufactured housing. It's so
Oh, it's a
the
blip.
incre- the increase in existing mobile home parks is so low it doesn't even make this chart. Okay, way less than 1%. I mean, it's basically zero. So mobile home parks, honestly, we think they're really my favorite investment. One thing I like too is when you don't own the houses, your capital expense is the lowest of all these asset types, multifamily being the highest of these, student housing, self-storage, parking. You're basically leasing dirt and, infrastructure. And the cool thing about that is while the dirt is not depreciable, Rick, the infrastructure is typically depreciable at a pretty high level. And so we can get some really nice tax write-offs. I mentioned if you own a home, you're just paying lot rent. I mean, look at our state, Virginia. What's the average two-bedroom apartment? This was a couple years ago.
Yeah, yeah,
It's
that's
higher
low.
now. Yeah, it's really high. It's really low for your area, especially, but 1,029 versus the lot rent at a mobile home park of one third, a little over a third of that. And
Right.
whether though, even if these numbers are off today, the point is the same.
Hmm.
So this is an extraordinary deal, and I want to be super clear. This is not a typical deal. This mobile home park was acquired the week COVID hit the headlines, February of 2020, for 7.1 million. The guy thought he might be able to get it up to a $13 million value. He bought it from a seller who had never been to the park in 5 years, 3 states away, 315 lots. And he actually was able to he got an unsolicited offer of 15 million in 10 months and sold it. And pretty stunning results there. Again, this is not normal, but it's absolutely attainable if you find a mom and pop deal. And even though this was very large, it was still mom and pop because it was run by somebody who hadn't even been there in over 5 years. Isn't that amazing?
It is amazing. Wow. Unbelievable. In
Yeah,
10 months.
I know. So, I mean, we can imagine seeing results like this in 5 or 6 or 7 years typically, and even that would be really, really good. But in a year, that's crazy. Um, I mean, here's the thing. We all think about multifamily. I wrote a book on multifamily, but multifamily is 93% of the large multifamilies out there or more are owned by companies. But look at this, 90% of mobile home parks are owned by individuals, like mom and pop individuals, okay? And 76% self-storage are owned by independent operators. And so, you can see some of those self-storage we saw earlier. They don't look anything like the public storage along I-95, do they?
No,
So,
but
but
they get the
there's a
job
lot of,
done.
yes, they do. They absolutely do. But it's widely known that you can put together a portfolio and make more money from selling a portfolio to an institutional buyer than selling one asset at a time. And so that's an opportunity we really want to take advantage of. So we really like self-storage. We like
So
mobile
that's why
home
you were
parks.
talking about how you pick an area that's outside the mainstream, and you're trying to group
Yeah,
these properties together so that you
right.
can do a portfolio sale. So
Mhm.
it's something of significance. So
Right.
got it.
Yeah, and that's if you can find somebody who's doing that well, that's somebody you consider investing with. This is RV parks. We really like RV parks. I actually rented an RV for the first time in Alaska last month. We had a great time.
Wow.
RV parks there's a supply and demand, ton of mom and pop owners. I mean, you can imagine. And taking an RV park for 2 to 3 to 4 million dollars and then expanding it, adding a water park that costs 2 million, adding glamping units, adding a big lake with whibbits. We all know what whibbits are, right?
No.
Right. Whippets are this floating obstacle course, and they charge kids like
Oh,
16 bucks an hour to run around and push each other off this. So it's
oh,
great.
fun.
Yeah.
That's
I
a
mean,
riot.
check this out. You can add a little fenced in area by a mobile home for a doggy den and charge $70. And I'll do it any day because I'm going to pay more than $70 to leave my dog in a kennel at home, especially
Right.
with
Good
food. And I
point.
want my dog with me.
All right.
And so we really like that. There's lots of value adds, more than I can even really tell you. I mean, this water park for a couple $1 million, turns it into a destination, you know. This one's in Leesburg, Alabama. It's on a big lake. And this operator was able to buy all this land over here and over here
Wow.
and over here. And so they're expanding out the RV, the little small RV area. They're expanding it out all over the place. This one's one of those, where it was this one was 14 million to acquire, but they're going to be at 24 million all in. So 10 million additional stuff they're adding, but it's already been appraised at over 26 million. It's not even done.
Wow.
So that's pretty
Beautiful.
cool. Yeah. So I made fun of myself multiple times today, including for calling my book The Perfect Investment. Um, but I actually 2 years ago, I discovered something that could be a game changer. Actually, I discovered two things that make multifamily a potential game changer, Rick. One of them is tax abatements. Tax abatements is getting with a city, state, or whatever government and getting the taxes wiped out for 99 years, just 99.
Whoa.
And basically, this example is a property this is the property here. It was acquired for $80 million. But the next day, the tax actually at closing, the tax abatements went into effect, meaning all the property tax in Texas, of all places, and this is another part of that same property. It's a two property portfolio, another part of the asset, I should say. Anyway, it was purchased for 80 million. The next day, the value was, get this, 113 million. Oops. And so that 113 million value means that 26 million in additional equity, the 26 million in equity grew by another, what's that? 33 million dollars in value, 33.5. And so basically the equity doubled overnight. Now, that's not realized. It's going to take 5 or 10 years to get that equity when they sell the property, but it's making cash flow all along the way as well. So
How did the abatement come about?
the abatement came about by taking 50% of the units and making them affordable. Now, the rents at this property were 27% below market. So by raising half of the units up to market rent and taking the other half and making them, let's say, 70% of market rent, I'm just making that up, I don't know the number, it creates an opportunity where the local government will say, okay, you won't have to pay property taxes as long as you keep that rent deal in place.
Huh.
So pretty cool.
Interesting. Yeah, that's very cool.
Yeah, so we've
And that's a
invested
nice
in,
looking place.
yeah, it is. And we've invested in places like this in Texas and even of all places, Jersey. So yeah, don't tell anybody. So
The Garden
but
State.
yeah. So there's another reason we love multifamily, but I'll tell you that later. A second, another asset type we like is value add light industrial. Believe it or not, of all the industrial in the country, only like 2% is light industrial market, the market value of light industrial. Yet there's huge demand for it. I mean, I'm talking about, those industrial parks you see. Some of them look like this, a 1980s building, but they can be fixed up for a couple 100,000 to look like that. And this one, they added nice signage, they added addresses so you can actually find a place you're looking for. They paved the parking lot, they put in roofs that actually don't leak, paint, landscaping, all kinds of nice things. If you've ever looked for an office or a space in like places like this is kind of how it looks beforehand. We literally looked at places like this, except it had file cabinets all over. It had old telephones and faxes on the floor, and the owner didn't care. Well, by taking that and improving the look of it, you can imagine how much rent could be increased. And I'll show you an example of that right now. So this one, I'm going to have to get my glasses to see this one, but the net operating income was 279,900, and it went up to, how did they do this? $937,000. The occupancy was taken from 55 to 100%. The rents were taken up, not that much. 62 to 68 cents a square foot. The internal rate of return was projected at 16 and a half, but it actually came out to be over 26%. And so we did not invest in this deal as much as I wish we had. But it's an example of a light industrial
When you
deal.
only accept 2%, you get these opportunities presented. I'm
Yeah,
sure there's a lot of like, oh, we could have done
yeah,
that one too.
yeah, yeah. This was before our time. I think the year, oh yeah, it sold in December 2019, and we didn't even start investing with this company till 2021 or two. One thing I love about light industrial is you can do a lot of diversification. I mean, a heavy
Mm.
industrial, a lot of them you just like renting a whole factory to one company that if they pull out, it's really bad. But, light industrial, they have, food and beverage, life sciences, churches, apparel, maintenance. I mean, tons of diversification. And so that's one
It's
thing I
wild.
like.
Yeah, I've even seen churches
Yeah,
in some of these places.
it's
Just
true.
it's it's a wide swath.
Yeah, it really is. Um, we also like open air shopping centers. Don't shout me down because these shopping centers actually are surprisingly recession resistant, especially with companies like Marshalls, TJ Maxx, Ross, Burlington, anchored by a Walmart, perhaps. A lot of these are irreplaceable things like, stuff you can't get through Amazon, including haircuts, nail salons, restaurants, all kinds of local stuff. And one cool strategy, Rick, is selling off the out parcels. So let's say you buy this at a 7% cap rate, which is pretty good, but you sell off this out parcel to a bank or Starbucks or whatever for a 5% cap rate. That means you're actually getting an arbitrage, by actually selling off this at a higher price per square foot, if you want to call it that. Make sense?
Mm-hmm.
All right, we're almost done. I also mentioned earlier that I think you noticed I like Warren Buffett, but I also mentioned there's another reason we like multifamily right now. We asked ourselves, what did Warren do in 2008? WW, wait, WDWD.
DWD.
Yeah. Well, Warren bought Goldman Sachs when nobody would touch a financial institute in October or September, I should say, of 2008. Nobody would touch one with a 39.5-foot pole, but Warren knew that they had a great intrinsic value and that they would bounce back. And here's the thing, he didn't buy stocks in Goldman Sachs, he bought preferred stocks, preferred equity. And we love preferred equity. Preferred equity has lower risk, it's at a better place in the capital stack. It has, excuse me, lower potential return than common equity, but the lower risk means it is a set return. Excuse me. So it
Bless
has
you.
a fixed return. And with interest rates as high as they are right now, and with banks' lending requirements being so tightened right now, and with so many troubles out there for commercial real estate, excuse me,
Bless you.
we've seen a lot of benefit to this. And I'll just kind of summarize by saying you can get mid to upper teens coupons by investing in preferred equity. So it limits the downside because, again, you're right behind debt. You're not getting a lien on the property, but you might get a personal guarantee from a multimillionaire owner. Um, these are really hard to source. They're really hard to get across the finish line. They're really hard to get approved by Fannie and Freddie. But we've done that. We've gotten approved by Fannie and Freddie multiple times. I think we've done 10 assets behind Fannie and Freddie debt.
Hmm.
Excuse me. So we don't do rescue capital. We don't do development deals, though that's a very valid thing to do. We do acquisitions of new properties, and our favorite is recapitalizing existing property. So right now we're doing a $14 million deal. Of course, it may not get across the finish line because we could still find a reason to say no, but we're trying to do a $14 million deal. It has current pay for investors, and then it has upside as well because it is equity. This is an example of one we already did $4 million workforce housing, there was 30% of common equity,
Hmm.
meaning there's 30% that would have to be lost before we'd be touched. Had 9% current pay cash flow, but 8% accruing and compounding upside. I was behind Fannie Mae debt, and we actually held back a lot of money in reserves to make sure that they would do what they said they would do, and then we pay them sort of like a construction lender. The IRR on this is projected at 19%. So it's
Wow.
not a 20 or 30 or 40% IRR like you've seen in the past 10 years, but it's also much less likely to lose money. And that's why we like pref equity. Another reason we like it, Rick, is that we can actually get terms. Like we can get basically, we can do forced sale rights. So if they're not performing as they should, we can literally force them to sell the property
Hmm.
and get our money out. So this is unavailable to individual investors unless you're a huge family office with, lots and lots of money. But this is the one in Atlanta we did. It's workforce housing. This one, we expected to get $200 in rent bumps by improving, by putting in these nice, but economic, but nice improvements. But they actually got $450 in rent bumps right out of the gate. And this was just 9 months ago. So,
Wow. Very nice bumps.
yeah. But even if they got infinite rent bumps, we wouldn't share in that profit. We would just get the set return, like we already said, and
As a
we're fine with
preferred
that.
equity. Yeah, that makes
Yeah,
sense.
yeah. So we hope the common equity people make more money than us. That means we're even safer, right?
Right.
Lots of reasons not to invest passively. I mean, if you want to be in control, don't do this. If you want liquidity, don't do it. If you want a short hold time, probably not best. If you're investing with an IRA, you need to know it may be subject to, UBIT, which is I'm forgetting what it's called, unrelated business income tax, I think,
It's
but
a tax. Yeah.
it's a tax. I don't think it's. I have an IRA. I'm happy to pay UBIT because it means I'm making a lot of profit. Um, because it's only on a certain portion of the profits. If you don't like filing in multiple states, our company, we're in 20 plus states because we're trying to get geographic diversification, right?
Right. But all of those require a separate tax return.
That's right. So they have a separate K1 filing, which means for the CPA, in my opinion, if you're a CPA and you're offended, I'm sorry, not you, Rick, but somebody might be. But as far as I know, it's just pushing a button. And they usually charge $50 to $100 per state. So if you're in, of course, a bunch of states like Tennessee, Texas, Florida, New Hampshire, Washington, South Dakota, they don't have state tax. But Michigan doesn't require an out-of-state filing.
Oh,
But before I wrap up, I just want to kind of turn from this very happy topic to a very unhappy topic. And I just feel like I need to say this, and it's part of my mission in life. Did you know, Rick, did you know if you took the record profits of General Motors, ExxonMobil, Nike, and Starbucks, and added about 50% to 100% more, that would be the annual profitability of human trafficking.
oh
And
my.
it's absolutely shocking. A movie called Sound of Freedom exposed this about a year ago. A lot of people saw that movie. A movie that I watched in 2015 that I still recommend is called Nefarious. Now, there's a 2023 Nefarious, but I'm talking about the 2012 Nefarious movie that exposes this horrible thing. So we thought, hey, we're in America. We are making some money. We should try to do something to help these people. The issue's huge in size. The problem for us who want to get involved is we don't know who we're sending money to. If I'm going to send a check for $1,000 to, somebody I've never met, maybe they're going to waste the money. We all hear about that kind of stuff. So we solve this by trying to do the same type of due diligence we do on operators. We did due diligence and we came up with a partner we really love, and it's called AIM, AIM, Their website's aimfree.org. And we recommend that people go check them out, see how they're rescuing slaves in Cambodia and also now starting in Belize. And we have raised, influenced, and donated over $600,000 in the past 30 months or so to these to AIM specifically. We know it's actually more than that now because they told me that one of our donors has been donating like 100,000 plus. So um,
Wow, that's
if
awesome.
yeah, it really is amazing. Well, that's one of our operating partners, actually. But if you want to get involved, just go to aimfree.org. You can reach out to me, but we don't take money. I mean, we would always just recommend you go straight to AIM or find another human trafficking organization, in your community or nationally that you like. We just really want to really put the word out about that. So if you want to learn more about Wellings Capital, I recommend going to wellingscapital.com/resources, and you can get a lot of the slides and stuff we talked about today. If you want to get on my email, if you want to email me to get a time, to chat, you can do that, paul@wellingscapital.com. And like I said, if you really want to give to this wonderful cause, I would recommend going to aimfree.org. Rick,
Wow,
it's been great.
fantastic. Thank you. Thank you so much, Paul. It's been wonderful. And I love how you ended this presentation with um, this trafficking issue, and
Thank you.
especially the fact that you vetted it. That puts me at ease, that I
Yeah,
trusting that they're going to do the right thing with the money, because you're right, we don't know, we just
right,
don't know.
right.
So
Absolutely.
fantastic. The what I have a couple just ending questions.
Yeah,
When you kind of you've jumped around, and you talked about diversifying, but then
yeah.
you really want somebody who's deep into it. And it
Mhm.
sounds like you guys are in, you got three or four things that you really like right now. How do these opportunities come to you? I mean, how are you being approached? Are you a big enough player now that they're coming to you, knocking on your door, or are you
Yeah,
actively seeking out these mom and pops, these they don't even realize they're diamonds. They're
yeah,
they're in the rough.
yeah. Right.
How are you finding them?
So we're finding operators. We only have, I believe it's 14 operators, maybe 15 at most in our current fund. And so we spend an enormous amount of time vetting them. We've got a team of 3.5 people who are out there looking for them. I did a call yesterday with a potential operator. I did a call the day before with a potential operator. I'm just kind of since I'm the co-founder of the company, I'm pre-screening these, sending them over to our team. They're
To
vetting
analyze?
them.
Mm-hmm.
Yeah, we also put the word out with about 150 debt and equity brokers. Hey, we put a flag out and said, hey, we're doing preferred equity. If you've got a deal you want to get preferred equity for, or JV common equity, you want to get across the finish line, call us. And we've got a 80/20 rule again. We've got a handful of brokers out of the 150 I contacted who have really sent us a lot of deals. And so that's been our favorite way.
Hmm. In this market right now, it's kind of like it's kind of crazy. It's a little bit unstable. I mean, at least I see it as being unstable a little bit, only because they're now talking about interest rates. Is your business affected by interest rates too much, or not so much?
Yeah, so our preferred equity business is actually taken off on the backs of increased interest rates. So it's really helped us a lot.
Okay.
Um, and it's really helped the operators too, because they couldn't do a lot of these deals if they didn't have us, and they can refinance us out once they do those value adds, like I was showing you in the
Mm,
Atlanta place, and they take us out, pay us off, and they can move on. As far as negative effects, the only effect it's had that I can think of right now is a lot of our 2019 and 2020 assets from 4, 5, 6 years ago are not selling that we're slated to sell about now.
I see.
They're going to be held longer until these cap rates and interest rates uh,
Shift.
go back to, I won't say normal, but go back a little bit more toward where they were.
Gotcha. Interesting. Very cool. Well,
Yeah.
thank you so much for your topic today, your information that you shared, and appreciate you. Thank you so much, Paul.
Rick, it's been a great joy to be here. Thank you so much. Tell Anna thank you. And everybody watching, again, thank you for your time this evening.
Have a good night.